Hey guys, it's Fabio here with the Trading Pit, and in today's video we're going to be diving a little bit more into the fundamentals of the markets. We're going to be understanding what drives price from point A in towards point B. So myself, I'm a big believer that fundamentals are what drive the market and that technicals are simply there just to provide you with an entry. Now, today's video is going to make it all a little bit more clear for yourself. We're going to be diving into interest rates, inflation, unemployment, GDP growth, and much more, and how these all relate to one another. Hope you guys enjoy this video, and let's dive straight in. So we're going to start off with talking about the core concept of fundamentals, which drive market direction. So first of all, let's talk about the most important and key fundamental indicator that moves price from point A to point B, and that is interest rate differentials. So what I want you to understand is that interest rates are what drives the markets. If we look at dollar yen, for example, this is the perfect first example that I would like to dive into today, is that a low interest rate will cause for a weak currency most likely, and a high interest rate will cause a stronger currency. The perfect example is obviously the dollar yen trade, which has been taking place since 2021, but actually much longer than that. And it is also known as the carry trade. So what happens in a low interest rate environment? Well, borrowing is extremely cheap, whereas in a high interest rate environment, investing into that particular currency or into that, let's say, investment environment, it becomes a lot more interesting. So what have we seen over the past few years? Well, in Japan, interest rates have been negative or near zero, while in the United States, they have been around 4.5% to 5%, all thanks to COVID, obviously. Now, interest rates are at the top of this so-called fundamental pyramid, and interest rates are changed or are decided on by a few important things. Again, all have to do with those fundamentals. Now, these are mainly going to be inflation. Obviously, these come out in the form of, let's say, CPI or PPI, or core CPI and core PPI. Then we have unemployment. We have, for example, surveys and indicators. Good example of surveys would, for example, be the PMI, or, for example, consumer sentiment. And then next to that, we obviously also have balance sheets. So these are mainly going to be focusing on the debt to GDP ratio. How much is a country borrowing? For example, at this point in time in the United States, we all know that the United States has been printing money like crazy, but also issuing bonds like crazy. So what happens in an environment like this? Well, there's massive amounts of debt. And this upcoming summer, for example, the United States needs to repay $6 trillion in debt. Now, at the current interest rates, this is going to be impossible because the current interest rates in the United States are set at 4.5%. To refinance debt at 4.5% is going to be, again, a massive burden for the US economy. So what is Donald Trump, for example, in this modern day trying to do? Well, he's dumping the stock market, causing the stock market to go down lower and lower, and therefore forcing the Federal Reserve and Jerome Powell to start lowering interest rates as well, to then boost the overall economy. This will enable him to refinance that debt at a cheaper level, and therefore provide the United States with a better fundamental position on a global scale. However, by then lowering those interest rates, again, as I already mentioned earlier, that will then cause for a weaker dollar, most likely, as it becomes less interesting to keep your money in dollars, as the overall interest rate is lower, and therefore the overall return on your money is lower, and potentially investors, hedge funds, or banks, or countries even, they'll look to invest their money elsewhere at a higher interest rate. Furthermore, we obviously also have geopolitical situations. It's actually what I just touched upon. The tariff sentiment in the world, for example, is very heavily based on this. If we, for example, look at a risk on and a risk off environment, this is all connected to the current geopolitical situation, but to geopolitical situations in general. Now, if we see, for example, that there is a war raging within the world, let's say the war between Ukraine and Russia, you'll see gold, for example, go to the absolute moon, but we'll also see more strength from, for example, the Swiss franc, the Japanese yen, or the dollar, which are traditionally seen as risk off pairs. On the other side of the spectrum, we have these risk on pairs, such as the Australian dollar or the New Zealand dollar, which will in turn most likely be weaker when we have a very risky environment. Now, we've had many risky environments in the past. Obviously, the 2008 financial crisis, this was a moment where the dollar mainly gained strength. The Swiss franc, the Japanese yen gained strength. Again, in 2020, during COVID, again, a very risky period within the financial markets. You see, again, large capital inflows into the Swiss franc and the Japanese yen. And you see a much weaker Australian dollar and New Zealand dollar. And now, obviously, most recently, when we look at tariffs, again, we see that there is a risk of sentiment within the markets. People do not know what to expect or do not know what is next. They believe that at any point in time, Trump might announce something crazy once again, which is now causing capital to flow into the Japanese yen and the Swiss franc. And the perfect example and how you can see this reflected back on the charts is if we, for example, look at the Australian dollar against the Japanese yen or the New Zealand dollar against the Japanese yen, or, for example, the Australian dollar against the US dollar. You see these pairs push in towards the downside as capital flows into the Japanese yen and the Swiss franc, making those currency pairs stronger and therefore pushing AUD/JPY in towards the absolute downside. And even at current times, Aussie Swiss is, for example, at an all-time low. Now, what I want to talk to you guys about as well is the institutional mindset, which revolves around anticipation over reaction. Now, you need to think how the institutions think when trading with these fundamentals, because institutions do not actually trade the news outcome itself, but they rather trade the expectation of what the central bank is going to be doing next. And a very good example of this is, for example, with NFP. So if we see bad NFP numbers come out, many times traders will think, okay, NFP comes out bad. This is now going to be bad for the dollar, so I should start selling the dollar. However, this is not actually always the case, because if the Fed announced that it's looking for a weaker labor market and for bad NFP numbers, what you at times see, you'll see an initial spike, for example, on the dollar in towards the downside, but then a massive reversal back in towards the upside. So it's always important to understand what the overall message is from, for example, the central bank, as the central bank will make decisions on interest rates. And these interest rate decisions are then again based on inflation or, for example, unemployment numbers. Now, for example, if CPI is high, so inflation is high, smart money will start buying the US dollar days before the Federal Reserve will even speak about it. And this is why price will often move before the news actually drops. And this is also where the famous saying comes from, buy the rumor, sell the news, because the big institutions are already going to be trading the anticipation of that potential move. And on the other side, if the news then, for example, goes against them, they'll already be hedged correctly in the right direction. And with hedging, we mean that you're going to be limiting your overall downside risk on the other side of the trade, because the big institutions, they're not just going to be selling one currency pair. Like most traders like yourself and I, who mainly trade in the retail space, if we, for example, look at Euro USD, we'll be placing a potential buy position. However, what bigger institutions will do is that if they're long on Euro USD, they'll also, for example, look for a limited downside risk by, for example, placing a sell on GBP USD. This way, if they bet on the correct potential outcome, they will make money and maybe a small loss on GBP USD. If the market turns against them and not in their favor, the overall downside risk for themselves or the loss itself will not be as large as if they only betted on that further Euro USD upside. So what I want you to understand after watching this video is that the overall market is driven by fundamentals. Technicals are most of the time just purely there to gain an entry on the overall fundamental swings within the market. The overall fundamentals of the market are like a pyramid. At the top of the pyramid, we have interest rates. Interest rates are what drive currency pairs from point A to point B. Interest rate decisions are then made on several different smaller fundamental news announcements, such as inflation, surveys, debt announcements, GDP growth, and other geopolitical announcements, which are done on a daily basis and which you can follow on, for example, Bloomberg, X, Reuters, or even within the Trading Pit dashboard. Now, if you have any questions about these fundamentals or you want to learn more about them, make sure to join the Trading Pit Discord. Myself and the entire Trading Pit team are active there on a daily basis, where you can feel free to ask any questions that you might have. Thank you for watching, and we'll see you in the next one.